so much for tuning into this earnings conversation with Tata Communications. They had a revenue beat, but a margin miss. It's an interesting quarter, wherein for a second quarter in a row, I believe that the data services business has continued to do well. Revenue up about 11.1%, and I reckon it was probably employee expenses which might have hit the operational metrics, but like I said in a previous interview, the way one swallow does not a summer make. One quarter of margin underperformance does not mean that's the indication for the year. Let me actually get in our guest, Kabir Ahmed Shakir, who is the CFO of the company, to talk about how did he think the quarter go by, some internal details, and then, of course, a view on Capex and other factors for 2023. Kabir, great having you. Thanks for joining in. Hope all is well.
Yes, all well, Nirish. Good to be back in the show.
So the pleasure entirely is ours to talk to you. Now, tell us a bit about, in a nutshell, how do you think the quarter went for you?
Actually, we're quite delighted the way in which the quarter has gone. This is the second quarter where our ambition of double-digit growth in the data services business has come through, and we are quite happy that we are able to do that, and that's been our focus for a long time. And the pandemic has now receded, and we are able to have customer conversations and fructify that into revenue. And the second element, if I just unpeel that also, is within the data business, we had put focus on the digital platforms and services part of the business. That share of contribution is what we want to inch up, so that it can become, half and half, and we want to move away from just being a telecom, only player to be a digital ecosystem enabler. So I'm glad that the data or digital platforms and services grew by about 17.2%, within that, which is also an indication of our strategy. So overall, quite happy with the quarter.
Including me, a lot of people would not understand maybe the long-term implications of this move away from being just a telecom provider to a digital services provider. One, on the business, two, on the way the company is perceived, three, on valuation, so on and so forth. So can you tell us, because we've never gotten a chance to speak about this, Kabir, the strategy or the thought process behind this, and what would the implications be, if not in FY24 necessarily, then the slightly longer term?
I think it's a very, very good question, and I'm glad that we are moving away from a short-term quarter discussion to this very important strategic question, also, Neeraj, and thanks for asking that. Clearly, connectivity is impacted by Moore's law, and you always find it becoming commoditized and no value getting generated out of it. So it is not something which occupies a CXO mindset. He or she probably relegates it to the purchase organization to run an RFP and procure like a commodity. We can continue to be there, or we can continue to start talking, start talking business value, to our customers. When you start talking business value, then you need to provide more than connectivity. Yes, connectivity and network and transformation of that is a foot in the door. In a typical digital transformation journey, there are at least 10-12 components that you need to bring them together. Yeah, there is applications, there is data, there is transformation that you actually do internally as well. Not one player is today servicing all those needs to an enterprise. The moment you try and do 4, 5 is when you actually get the eyes and ears of the boards that you can let in. And the whole idea of us shifting from products to platform, having deeper with fewer, and talking the holistic customer drivers of enabling borderless growth, of improving their productivity and efficiency, reducing their risks, bringing agility to their operations. All these customer drivers actually help us to get into that conversation. And that we are then able to then say, okay, we will, of course, provide you an underlay, which is a secure, underlay, but can we do more than that? When you are engaging with your customers, when you are, having your conversation with your employees, how can my collaboration, services, make a role there? All your products and services are today getting connected. there are going to be about 85 billion IoT devices in the planet in a few years' time, which is staggering when you actually look at it. For every living human, there is going to be 6 to 7, such devices. And our ambition is quite high in that space in IoT. So we would like to therefore add value, not just from a connectivity perspective, but bring products and services that add value to our customers. That's the reason why this shift becomes very, very important for us.
Okay, we'll continue with the long term for a bit, and then I'll again come back to the quarter. But first, this is interesting. So, part one, for you to get the foot in the door because of the nature of the quote unquote commoditized services that you're giving is easy because it's critical infrastructure, so to say. But in order to give the other pie, I'm presuming that you have to replace somebody who's been doing this. The incumbent would be doing this for a while for the company, I presume. Please correct me if I'm wrong. So how easy or how much of a price cutting or undercutting or how much of more expensive labor do you have to get on and more frills do you need to add on to replace somebody who would be doing this kind of work? And again, please excuse if my assumption was wrong.
Yeah, I mean, you're partly right, Neeraj. Yes, there is partly, in terms of replacing, certain incumbents, but the universe is expanding big time and exponentially. Today, if you look at large enterprises across the board, across geographies, the large portion of their OPEX and Capex is actually shifting towards digital. And these are new use cases. These are new use cases that bring extremely high ROI, to the enterprises. So I'm actually enthused and inspired by the fact that this creates new market opportunities for us. Connected cars, if I were to just talk just as one example, is not replacing anybody because we didn't have connected cars, right? And that's going to be definitely going to be the scene, going forward. Every car is going to be run by an operating system. I mean, today it may be EV, and I'm sure every geography is announcing, like UK has announced that by 2030, all the cars in the country will be electric. So once they move to EV, and that's the starting point, all of them are going to run on operating system. When they run on an operating system, that operating system needs an upgrade and an update. And cars are not, I would say, equipments that are static in one place.
Yeah.
So today, device manufacturers are telling and calling us and telling us, I want a 24/7 connected car. I don't care whether it is LTE, whether it is 4G, cellular, Wi-Fi, broadband, satellite. Give me an always connected car. So therefore, this one example, in the interest of time, is a completely new use case. And they are looking for people who can come and offer that solution so that they can then offer that solution onto their customers, as well. So whether it is telematics, whether it is infotainment, and multiple such use cases that actually come with the connected car industry as a whole.
In a manner of speaking, please again correct me if I'm wrong, are you adding an ERD business of sorts to the existing comms business that you would have?
Yes, absolutely. We would like to be looked as a comtech company, that we're going to use comm as as our foundation layer, but there are several such value addition that we can actually do to our customers.
Okay, and is this probably one reason why employee costs as a percentage of your overall sales are inching up higher, because this should be newer verticals or newer talent that you're getting in order to serve, which will show results later, but for the immediate term, say the next couple of years, will probably have a higher bearing on what the employee cost structure looks like?
If I have to be perfectly transparent with you, it has three components to it, Neeraj. One of them is absolutely right. We are investing for the talent of the future. So we are, getting in a lot of engineers who are working on all these solutions, whether it is, our CPaaS offering, whether it's our Move IoT offering, whether it's our security, all of that place, we are getting in new talent. But I also want to remind us, we keep forgetting, only 2 quarters ago, we used to talk the great attrition. And we did have a lot of people, leaving us, and the talent that actually came in, came at a much higher level. So therefore, we also then had to, do a wage inflation, and the merit increase that we did last year, for example, was one of the highest that we have done in the recent years. And that was to just be in touch and pace with the competitive situation in the market. And third element, I would say, is the retention that, that plans that we have done for our existing key talent, as well. So I would say combination of these three factors, base increasing, retention plus new hires, all three have led to increase in employee cost.
For how long does this last? Because this, I believe, is a long gestation plan that you put into place. For how long and until what levels would be comfortable bearing these higher costs? I'm sure they are part of a plan. Just trying to understand what that plan is.
And I want to put it in perspective also. These higher costs are not, that high. We used to operate around 13.8, 14% of employee cost to turnover, 2 years ago. We are now at around 15.5, 16%. So it's about 1.5% is what the increase that we have. And I'm hopeful that this will pay back in higher revenue. Yeah. So as organizations, we probably can't be too short-term focused, and we need to take a slightly medium to long-term, impact. And the engineers that I've hired in, they will start generating their productivity into a product which my sales organization is going to go and convert into revenue. So that will soon happen.
Got it. My other question, Kabir, is on growth rates per se. So it's for the size that you have. Obviously, this is not bad growth rate at all. But when I look at individual CPaaS companies, individual ERD companies, individual solution companies, their growth numbers, though the company size is much smaller than yours, are disproportionately higher compared to the growth rates that you're putting out. Now, is it a factor of size, or are you even telling me? I'm not saying you are, but I'm asking you that are you even telling me that because you are in this build-up stage right now, in the transition stage right now, in this getting your foot in the door stage right now, the numbers, the growth rates are looking different than what they probably will about 12 to 18 months down the line?
Absolutely. I mean, that's our definite ambition. Again, we should not forget the historical place from which this company came in. We were in low single digits. Growth is what we came in. Our history was, of course, voice, and we have defocused on voice, put a lot of emphasis on data. And our first, I would say, pit stop, and I'm not going to declare victory as yet. It's just 2 quarters. We need to do that consistently more. Is the double-digit growth trajectory that we would like to sustainably get there. And once we do all these businesses, whether it is the Move business connected solutions that I talked about, whether it is IoT, whether it is media, whether it is security, all of them have very good potential. Now, whether it is 12 to 18 months or shorter or longer, I don't know, Neeraj, because I don't know when the inflection point will come for each of these businesses. And some of the deals that we are working on, transformative deals, can really take the trajectory to a very different level altogether. But these are our growth engines, and these are the ones which will take us to the trajectory that you are comparing us to.
Okay. No, trust me, I'm not trying to compare, because like I said, the company sizes are very, very different. So obviously the growth rates would vary, but I was just trying to get a flavor. Just wondering, this transformative deals that you're working on, and one doesn't know when a deal gets fructified, but do you reckon there's a high probability that you might see one or two of these transformative deals seeing fructification in calendar year 2023?
I don't think so. Not in 23. These are all clear, order book and funnels that work on, and these all need to be converted into solutions. These are not packaged products that we actually have. So we need to understand the customer's requirement and then solution them, and then of course there will be a competitive process that we will probably go through before it happens. So these are definitely will have long gestation.
Okay, well, a view on 2 places which guzzle cash, if you will. One are the recent acquisitions that you've done. 2 is the view on Capex as well. We can argue about Q4 or FY24, but I'm essentially saying the next 12 to 18 months.
Yeah. Firstly, I won't say guzzle cash. Neeraj.
Sorry, it's a term that I use, but yeah.
No, I know. I'm not trying to be pedantic, but I'll tell you, why I don't say that. Firstly, our net debt is one of the lowest in its recorded history, right? We have been extremely focused on balance sheet hygiene and financial prudence. That is reflected in how our debt is actually shaped. That's the first point. The second point that I would take the liberty of probably blowing the trumpet of my team, who have done a fabulous job. We are funding, and we will fund. We are not yet paid for Switch. We will fund this entirely coming from working capital and operational efficiency. We are not going to borrow any money for paying $58.8 million to Switch. It is all come, if you actually look at our financials, it's all coming from just operating hygiene and bringing in that discipline in the organization. So literally, working capital movement over the last 2 years is going to fund for this acquisition. Then the next point on Capex, our cash Capex, or the spent Capex as we call it, is still low than what we would like it to be. Our approved Capex is higher. So therefore, you will see the catch-up effect maybe 2 quarters down the line, when you see that all those approvals that we have made, and when the deliveries actually come through, we'll start paying for it. Our cash Capex is still lower, but that is one area where I would like to spend a lot more. And we have given our own indication that we would like to take it to $300 million, of spend. We are still not yet there, and that is because of supply chain deliveries, longer deliveries that we had. And second, also good work done by the supply chain teams in negotiating better payment terms. So therefore, they are not yet due to be paid. But you will see that happening. The good part of this is, and I've explained this to a few investors as well, there is no one size fits all or a democratic approach to Capex. We have 3 kinds of Capex. We have maintenance Capex, which has a threshold and they need to operate within that threshold. We have customer success based Capex, for which there is no limit, because they are directly related to revenue. And I would be stupid, to put a budget or a constraint on that. And because more I spend, more top line I get, and it gets into the virtuous circle of growth that we are actually trying to drive. So I would say spending more Capex is actually good for this business, provided we continue the rigor on hygiene on our business cases and returns that we have in this organization. And that is reflected in our ROCE. We used to be at a very, very abysmal level 3 years ago, single digits. We are now, last quarter, this quarter that we declared is 28.4% of ROCE. So I think the investors should get the confidence that we will, even if we increase our capital spend, we will actually spend it, by generating these kind of returns for them.
You reckon these are sustainable numbers, or can be improved upon as well, the return on capital employed?
Well, I have given a guidance of greater than 25%, is what I had mentioned. I would like to operate between 25 to 30%.
Okay.
Because as we do some large investments, they are not going to be fully utilized on day one, Neeraj. So therefore, that's the reason why we want to give. And we were also operating, at a good level because of all these approved Capex that we have, given purchase order for. We have not yet paid for it, so they don't show up as yet.
Most certainly. My final question, and you mentioned about net debt per se. The quarter on quarter, of course, the finance costs have come up. YOY, this is still looking elevated because of the larger nature of equity plus debt, I presume. But you reckon that the debt levels and the net debt levels would continue to be at the levels that they are, or will they see marginal increase because of the Capex that you're doing?
Yeah. Firstly, look, my stated, I would say, target or guidance, whichever way you look at it, is 2x of my EBITDA. And we are operating well under the 2x. In fact, every quarter we are only getting better. So we are now at 1.4x of EBITDA is what we have as a debt. And I would like to have that optimal level of gearing. Now, the fact that we have not spent on Capex and other efficiencies that we have done has brought our debt levels down, which has actually helped us because of the rising interest cost that we actually see. It has only come to help us. But having said that, despite increasing interest costs and the EBITDA, which has actually come down, our PAT has gone up, right? So we've looked at every element, so which is whether it is tax rates, whether it is working capital, whether it's other income, and everything else that it sweats, and delivers to their potential is what we have looked at, and therefore we are able to deliver a higher PAT, for our investors, and a higher EPS as well.
Got it. Well, Kabir, we wish you all the best for executing all of these and more, and in the transformation of your company, if I can use that term. Thank you so much for taking the time out and explaining to us some of these elements. I'm sure more explanations will come along as we talk more and more.
Lovely. Thanks for having me, Neeraj.
The pleasure was ours. Viewers, thanks for tuning in.